Hi everyone, let me introduce myself. My name is Ainun Mardiyah Putri, NPM 2441200, Class Act 24. Welcome to today's video. In this video, I'll explain the meaning of an account in accounting, the 5 main types of accounts, their normal balances, and how to record transactions in the general journal. Let's get started. Definition of an accounting. In accounting, an account is a record that tracks financial transactions related to assets, liabilities, equity, revenue, and expenses. An account helps categorize financial activities, making it easier to prepare financial statements. Each account in the general ledger represents a specific category of financial activity. For example, when you receive cash, it affects the cash account. When you pay for utilities, it affects the utility expense account. These accounts give us a clear view of how much a business owes, earns, and spends. 5 types of accounts and their normal balances. There are 5 main types of accounts in accounting. 1. Assets. Assets represent what a company owns, such as cash, equipment, and receivables. Normal balance. Debit. This means an asset account increases with a debit and decreases with a credit. 2. Liabilities. Liabilities are what the company owes to others, like accounts payable or loans. Normal balance. Credit. A liability account increases with a credit and decreases with a debit. 3. Equity. Equity represents the owner's claims on the company's assets, such as owner's capital or retained earnings. Normal balance. Credit. Similar to liabilities, equity accounts increase with a credit and decrease with a debit. 4. Revenue. Revenue is the income earned from business activities like sales or services provided. Normal balance. Credit. Revenue accounts increase with a credit and decrease with a debit. 5. Expenses. Expenses represent the cost incurred by the business in its operations, such as rent, salaries, and utilities. Normal balance. Debit. Expense accounts increase with a debit and decrease with a credit and decrease with a debit. How to record transactions in the general journal. Recording transactions in the general journal involves a few steps. Let's break it down. 1. Identify the transaction. First, identify what the transaction is. This includes figuring out which accounts are involved and whether they are increasing or decreasing. For example, if you purchase office supplies with cash, you need to affect both the cash account and the office supplies account. 2. Determine which accounts to debit and which to credit. Now, decide which account should be debited and which should be credited. Remember the normal balances for each account. Assets and expenses increase with a debit and decrease with a credit. Liabilities, equity, and revenue increase with a credit and decrease with a debit. 3. Record the transaction in the general journal. The general journal is where all transactions are initially recorded. A journal entry consists of the following: date of the transaction, accounts involved. The account to be debited is written first, followed by the account to be credited, which is indented, amount. Record the amounts in their respective debit and credit columns. Explanation. A brief description of the transaction. Here is an example. On October 12th, the company purchased office supplies worth $500 in cash, debit. Office supplies $500. Because assets like supplies increase with a debit. Credit. Cash $500. Because cash, another asset, decreases with a credit. Your journal entry would look like this. October 12th, 2024, office supplies $500, cash $500, purchased office supplies with cash. This process ensures that every transaction follows the double entry accounting system, where every debit must have a corresponding credit, maintaining the balance in the accounting equation. Assets, liabilities, equity. Why journal entries are important. Journal entries are the foundation of accurate financial reporting. They help keep a detailed record of every transaction, ensuring that the company's books are up to date and accurate. Without proper journal entries, it would be difficult to track financial performance, prepare financial statements, or identify potential errors in the accounting records. Conclusion. That's it for today's video. We've discussed the meaning of an account, the 5 main types of accounts in accounting, their normal balances, and how to record transactions in the general journal. I hope this video has helped clarify these basic concepts of accounting. Thanks for watching and see you. I hope you enjoyed this video, guys. Accounting teaches us to be responsible for every financial decision.